Hello and welcome to the launch of the DMI's Public Blockchain Working Group report. I'm Lewis McClellan. I'm the head of content for the Digital Monetary Institute. Delighted to have you all here in the audience today listening. And yeah, thank you very much for coming. We hope you enjoy the report. I'll start off by thanking the members of the working group. You're going to be hearing from all of them today. So in alphabetical order of institution, from Aptos Labs, we have John Sable. From Hedera, we have Isadora Arredondo. From Mince Indra Group, we have Vivian Clavel Diaz. From Ripple, we have Matt Osborne. And from the Stellar Development Foundation, we have Marcelo Praches. They've been a really immensely supportive group. It's been a delight to work on this project with them. They've all been very enthusiastic participants in all the meetings with regulators we've had, and they've been very, very helpful, offering lots of insights and ideas when it came to putting together the report. So yeah, it's been a real pleasure to work on the project with them. You'll get to meet all of them in a moment, but first I'm going to run through a few points about the report to start off with. So essentially, we came up with the idea for this project earlier in this year, and the idea was essentially that despite the increasing popularity of public blockchain technology as a vehicle for regulated financial activity, there are some regulations that make it difficult for commercial banks to make use of the technology, and so as a result, we're seeing a lot of banks experimenting with private blockchains. And we're not really going to go into whether public or private blockchains are better per se, but I think that the choice about the architecture that a market participant uses should be up to the user. They should be able to determine for themselves what suits their needs. At the moment, though, we feel like the regulators, some of them in any case, have their thumbs on the scales a little because it is difficult to use public blockchain. And the regulator's decision to do that is based on a belief that public blockchains can't exhibit the technical features that are required for regulated financial market activity, or a feeling that, because they don't understand the capacity of the technology, they have to keep it away from banks. And that's a reasonable starting point for a regulator that has to protect the integrity of the financial system that they're supervising. But the technology's moved on a lot. It's time for the regulators to move beyond that stance as well. And that is what the working group set out to do. So we spent the summer holding meetings with regulators from around the world and bringing bankers into those meetings as well, just to kind of build our understanding of their concerns and kind of improve their understanding of the features that are possible with public blockchain technology. And so the approach that we wanted to recommend is one that is kind of agnostic of technology. So just based on the technical capacities of the tools. If the technical requirements can be fulfilled, then it's a valid choice, at least from a regulatory perspective. That's how we feel it should be. So what we have discussed fairly extensively over the past few months and in the report is what those areas of technical functionality that are what they should be able to deliver, what any infrastructure that's going to be used for regulated financial activity should be able to deliver. So I'm just going to share my screen in a moment, and that will just to bring up a few of the key points. A few of the key points, the areas at least that we feel should be covered for regulators, the areas that they should have concerns over and that public blockchains have to be able to exhibit. So governance is a big one, obviously. Regulators that we spoke to, many of them are kind of concerned with the idea of decentralized governance and ensure if they're used to doing things based on liability, can you still do that in the context of decentralized infrastructure? We feel like the main handle should be from a regulatory perspective, should be on the issuers of the tokenized securities and the operators of financial services on the infrastructure. The protocol itself is not actually an important regulatory handle. It doesn't need to be directly regulated. Operational resilience, obviously, business continuity, very, very important in the world of systemic capital markets, financial infrastructure. Obviously, public blockchains typically do have very high standards of operational resilience, but there's ways of improving on that, ensuring that there's fallbacks in place for business continuity, whether that's to another blockchain you can fail over to, or onto traditional rails. Similarly, asset control. So, while public blockchains have a reputation for openness of participation, regulated financial instruments can't be and shouldn't be accessible to everyone. You don't want, sanctioned parties to be able to hold securities, or people that are not eligible investors, etc. And, in the event of mistakes, you want to be able to freeze things, possibly pending court decisions. And these are features that are not possible on a blockchain like Bitcoin, the Bitcoin blockchain, but on other blockchains with permission token standards, you don't have to have permissioning on the underlying protocol layer if you have the permissioning done via the token. So it's, yeah, a very important feature, but one that public blockchains these days are capable of delivering. And then we're looking at settlement finality. Again, similarly, the Bitcoin blockchain has what we refer to as probabilistic settlement finality. I won't go into the technical definition of that just now, but what you need to know in regulated finance is that when settlement has been declared, that it is final, and you're not going to have the transaction reversed unpredictably at a later date. Deterministic settlement is something that modern blockchains are capable of delivering, and many have been designed to achieve that and achieve it quickly. Obviously, you need the regulatory architecture around it to declare legal settlement as much as technical settlement, and that's something that the regulators need to appreciate as well, to make sure the regulatory structures are there as well as the technical ones. Confidentiality, again, public blockchains typically have a reputation for transparency, and that's true. But in regulated finance, users do have a certain right to confidentiality. You don't necessarily want your counterparty to know the details of everything that you're trading, how much of everything you're trading. Obviously, regulators and financial platforms have to be able to supervise for market abuse and things like that. But you should be able to do that without compromising confidentiality. Interoperability, another particularly important one when you consider the operational resilience. I mentioned the idea of failing over to another blockchain. So ideally, you want tokens that can move between chains seamlessly, and that means you don't end up with siloed liquidity locked in particular platforms and dependent on those platforms. Throughput and fee stability, again, looking back to something like the Bitcoin blockchain, it's not got a particularly high throughput, right? They struggle with transactions per second. Certainly, if you were to map the number of transactions per second in wholesale capital markets onto the Bitcoin blockchain, it would really struggle. You have to rely on things like layer twos to deal with that. And at times of peak transactions, the cost goes up a lot. This sort of infrastructure is not suitable. But it's a feature of the Bitcoin blockchain, not public blockchains as a whole. Many of them have been built with high throughput in mind, and can handle high transaction load without spiking fees or anything like that. And then finally, validator communities. So public blockchains, you have certainly public permissionless blockchains have potentially large validator communities with un-KYC'd parties. And it depends on which regulator you talk to, how they think about that. And there are ways around these. Sometimes you can, some public blockchains allow you to use a restricted set, a permission set of validators. Others allow, it's permissionless, but you can choose a set of known validators. There's a variety of ways to address this, but what we need from regulators is some clarity on what they feel the most important, what they feel is important there. And then, as with everything else, once people know the requirements, they can build the products and tooling to match that. So I'll stop sharing there, and without any further ado, I am going to open it up to discussion. So you'll hear from the rest of the working group now. But just to remind everyone in the audience, there is a box for questions. Feel free to put those in. They'll be passed over to us, and we'll get to as many as we can. Marcelo, I'd like to start with you. Can you give a little picture of the regulatory environment at the moment and the challenges that it's causing at present? Yeah, be great. Thank you.
Yeah, thanks, Luis. Marcelo Prates. I'm policy director at the Stellar Development Foundation. And yes, and you mentioned that, Luis, and the report has an analysis on that as well. It seems that the that distinction between public permissionless blockchains and private permission blockchains have kind of outlived their utility, right? Because they lead to an oversimplification and they are blurring relevant distinctions between blockchains and especially between public blockchains. And we've seen, I give you two examples of how this binary distinction is not working so well. If you look at the BCBS rules on crypto exposure for banks, the BCBS, they decided to use these two categories, public permissionless and private permissioned. And in the end, they created, even if involuntarily, they created a bias against public blockchain. So a stablecoin or even a tokenized money market fund share, if issued on a public permissionless blockchain, could require banks holding these assets on their balance sheets to increase their capital at a one-to-one ratio, which does not seem to be the goal and the intent of the rule. Another example, recently, HM Treasury in the UK, they have a recent proposal, a request for tenders for institutions interested in tokenizing gilts. So tokenizing the UK's government securities. And they are explicit in the tender documents. They say that any institution interested in participating in presenting a tender, they should utilize a private permission network. So instead of talking about features that they would like to see from any infrastructure used for the tokenization of gilts, HM Treasury restricted in the tender documents. They use only private permission networks could be used there. So, and the proposal here would be how do we avoid these issues, right? And you will see on the report, we have some proposals there, some recommendations, and Luis mentioned some of the policy recommendations. But the idea is to, first of all, to acknowledge that not all blockchains are created equal. You have a diversity since the first one, since the Bitcoin blockchain. You now have a host of other chains that can be used, especially for payments and tokenization. So the idea would be to build a more accurate and useful analytical framework for blockchains, and that can be done using a risk management perspective and focusing on the features and characteristics that Luis mentioned at the beginning. So that would
Yeah.
be the main idea here.
Thanks very much, Marcelo. And the good news is it does seem that the Basel Committee, under extensive pressure from people on this call and many others around the world, look like they are going to revisit the SEO 60, the Prudential Standards, which it's late, but it's good to see them kind of responding to that pressure. Thank you, Marcelo. Matt, anything
Sure.
you'd like to add on the regulatory environment at the moment, how it's developing, maybe?
Yeah, thanks, Lewis. And to introduce myself, I'm Matt Osborne, and I'm the policy director for Europe and the UK at Ripple. And Ripple is a digital assets firm that does a lot of work on the XRP ledger, which is another example of a ledger that is designed for institutional finance. So in terms of the regulatory environment, I agree with what Marcelo said. I think I would add, there has been a problem of oversimplification, which I think goes back to the fact that regulators and central banks are still learning about these technologies, and over the last few years they have lacked a detailed technical understanding of the sorts of features that public blockchains can have in order to mitigate the sorts of concerns that they have. So I've had conversations in the past where it really seems that they're most familiar with something like the Bitcoin ledger, and that's what they're thinking about, and they're identifying why that couldn't be used for institutional finance. So I think many of us would agree with that assessment, but there is a growing appreciation, and this is very welcome, of the diversity of blockchains, and that some blockchains have been purpose built to address the sorts of concerns that regulators have. But I think the key challenge for us as an industry is actually one of educating regulators and central banks and making sure they have the expertise, the technical expertise that they need in order to be able to judge whether or not a particular blockchain delivers the sorts of outcomes that they are looking for. And that's I think it's that's a challenge for them, but it's also a challenge for us.
Yeah, yeah, absolutely, and certainly something that we encountered a lot over the summer. Sometimes the attitudes are improving, but there is sometimes an element of surprise when you say this is something that public blockchains can deliver. Isadora, can I come to you next and just expand a little bit on the attitudes the regulators have towards public blockchain, and I imagine you can expand on this oversimplification as well. How are these attitudes changing as well?
Yes, thank you, Lewis. And my name is Isadora Arredondo, and I'm Global Policy Director for Hedera, a public permissioned blockchain. So I would say there is a diversity of attitudes, and there's been an uneven evolution across jurisdictions. And I think you have all alluded to this point with your different interventions. I think there are different levels of knowledge and comfort with public blockchains across the global regulatory community. So we can't put all of the regulators in the same bucket. And I think these differences are shaped not only by technical understanding of the underlying infrastructure, but also by political economy factors that kind of shape their openness towards disruption in banking. I think, in my view, as Marcelo said, the core regulatory challenge lies in balancing the need for nuanced guidance that reflects, I think Matt also alluded to this, the different architectural risks, with the goal of maintaining general principles that can be applied consistently across jurisdictions, but that are also future-proofed, because we are seeing, different architectures kind of arise with time, and we don't want to codify things too kind of strictly. We should remember that the BCBS standards that are now kind of like the most popular standard, but also one that is being revised because of this feedback that regulators have received. They were drafted a while ago, and I think both factors in terms of the technical understanding and the political environment or the political appetite for broader industry adoption were different. But we are seeing many jurisdictions take a more kind of interpretive approach to these standards as currently drafted under headings such as, like, what does technology risk look like and how is it different from asset risks, and also others that are thinking about delaying their implementation. I think on top of the conservatism that we've just alluded to in relation to the first kind of like take on BCBS is the question of some trickier questions that are legal in nature rather than regulatory, such as delineating roles and responsibility that were historically applied to systemic providers with whom firms could have contractual relationships, to now new actors that operate in an environment of distributed market infrastructure. And I think this is a really difficult nut to crack. I'm sure we'll go through the question of legal settlement finality later on, but it requires a potential reconfiguration of some of the roles in these landscapes. I think just before we move on to the next question, I think it's interesting to note that, for instance, the Bank of France actually tested bond issuance as far back as 2020 on Ethereum. And also we've just seen UBS, PostFinance, and Signum completing a legally binding tokenized interbank payment. So there's movement and there's kind of like ambition that is changing. But we're seeing kind of like regulatory approaches remain fragmented and somewhat cautious.
Yeah, absolutely. It's very important to note there have been a lot of really exciting projects in the public sector as well as the private sector exploring public blockchains. John, anything to add to that? The evolution that we're seeing in regulators' attitudes and where it's come from, where it's going.
Yeah, absolutely. And Louis, before I get into it, wanted to thank you personally and DMI for including myself and Aptos Labs and the working group and today's presentation. As way of introduction, John Sable, and I'm representing Aptos Labs, which is the core team contributing to the Aptos blockchain, which is a high performance proof of stake public blockchain. And Isidora covered a lot of great points, and I think we definitely are seeing an evolving view from regulators, and I agree it does vary regulator by regulator and region by region. And I think all of us here on the panel have done lots of educating, not only over the course of the last several months, but I think the last several years. And I think the technology, for better or worse, can be complicated to understand for regulators, and there's a lot of nuance, and the technology is advancing dramatically, and so there's a lot of new features, and as Marcelo and others have pointed out, that not all blockchains are kind of the same. But maybe
not
one
just
area
for regulators, but for poor head of contents at think tanks, we find it hard as well.
That's right. And I think, I'm based in the US, and I think we've seen a dramatic change in regulatory approach from US regulators. And I think it's, obviously in large part due to the change of administration and kind of the philosophical approach to the technology. But I think it's also a result of a lot of the outreach and education that's kind of been taken on by industry. And, it's kind of manifested itself in a few different ways, but there's been a huge increase in the willingness of regulators to engage with industry, and also industry being willing to engage with regulators without fear of subpoenas or other sorts of enforcement type threats just for discussing the technology. And we've seen, the SEC has this task force, and they've had roundtables that have gone around the US. The CFTC has a number of subcommittees where they engage with industry, including our CEO has had an opportunity to engage there. And this has, I think, resulted in the US especially with banking regulators, with having some more evolved and nuanced guidance, especially as it relates to public chains, which has shifted from this approach of you must ask for permission and we're not going to give you permission to, you can engage with this type of technology if you can meet the same rigorous risk management standards as any other product or technology that you would use. And I think that kind of tech neutral approach is beneficial not only to the banks, but I think also, obviously to industry. And so the question is, why is that happening? And I think it's obviously a part to more of an openness to innovation and the technology, but also a recognition that the technology has advantages for finance, and that the technology is evolving in ways that allows institutions to meet their regulatory obligations. So I think just from the US perspective, I think that's been a really interesting kind of evolution, and elsewhere too. It's not solely the US, but
but I think the US is partly the driver. I think a lot of other regulators have been kind of spurred into action by the dramatic changes in the US. We've got some great questions coming in from the audience. I will come to those in just a moment, but just before I do, Vivian, I wonder if I could come to you just to talk a little bit about we'll get into, and we'd certainly in the report get into more detail on the sort of technical policy changes that are required for public blockchain, but there are some mindset changes as well when it comes to treating sort of unique decentralized technology like blockchain. I wonder if you could describe that in a few words for us, Vivian.
Oh, well, thank you, Luis. I'll start by introducing myself. I'm Vivian Clavel, and I am head of open banking and digital currencies in Minset, an Indra Group company. We are a technology provider. So differently from the rest of the panel, we are not a blockchain itself. So but we help our clients understanding this technology, and amongst our clients are supervisors and central banks, and of course commercial banks. So it was a pleasure to participate in this group, and and absolutely, there's a major mindset shift in between regulators. I mean, and it's not comfortable. I mean, we have seen them like kind of being not very comfortable with some of the questions that we presented, but they were very open. I mean, now they are wondering how should the regulators supervise and control when this control is shared between institutions and technology. They know they are being educated that governance can be different. It's not the same across the blockchains, and this is not easy for them to understand. They need to understand that. So if governance is different, responsibility is different, and risk is moving between the institutions and the technology. So that's a major shift on mindset. But there's a lot of initiatives. There are a lot of initiatives worldwide that we have talked to. And I think as a group, we have seen a lot of first steps that are great. We have addressed that there are still some huge gaps, but there's also an opening for a space of collaboration between the industry and the regulators. And just if you allow me, I would like to mention about the progress, because for me it's major. I mean, regulators are moving away, even it's very slow, from fixed rules and strict rules to adaptive frameworks and phase authorization metaphors. Like, for example, in the United States, we go from the Genius Act that's already shifting to the FIT 21 that is coming ahead. In Europe, we have the DLT pilot regime, and in UK, we also have a sandbox. So it's a move towards real-world testing, to learning by doing, and that will help improve the rules as the market works. And there are, but I also would like to address the major gaps and major questions that are still open. And the main ones I would like to address is how do we bring permissionless blockchains safely into the regulated finance? So that's a major question, is still out there, and steps, but I see steps. I think see light at the end of the tunnel. And another is, how do we make legal frameworks consistent across border and asset types? And I may repeat myself again, but what I see is the space for collaboration, and that's a good thing. They are willing to listen to the industry, to listen to the technical providers. So I think that's great news.
Yeah, no, it's a good point. It's nice to hear everyone mention that. I think we were all positively surprised by the attitudes of the regulators that we met with. They have doubts, but they are definitely at a stage where they realize this is something they can learn more about. And there's not the same. I think even a few years ago there would have been a much greater air of suspicion or mistrust from regulators than there was this year when we started talking to them. We have some really interesting questions coming in from the audience, so I'm going to start with one of those, which is something that we've addressed at some length in the report. So yeah, feel free to jump in on this if it's something you'd like to talk about. So the question is, it's very hard to see how a set of anonymous validators whose composition can change dramatically can be trusted by a regulator for systemic safety. What are our thoughts? And yeah, it is a really interesting point. And that's certainly something that regulators' opinions differ on. We talk about two different approaches in the report. One is sort of a legal approach where, you know, what is it you really need to know about validators? Is there a reason for them to not be anonymous? Some regulators will say, yes, there is a reason, others might not. It's not obvious that a community like that doesn't make active choices needs to be needs to be KYC'd, but others will say that it does, and there are ways around that process. There are ways to deliver that in public blockchain contexts, and I think basically all the blockchains represented here take a slightly different approach to doing that. I don't know if we'll go through all of them today, but yeah, who'd like to jump in? Yeah, feel free, or I can pick on someone, but Marcelo, you've unmuted. Yeah, let's go for you.
Thanks, Luis. No, that's a great question, and that's a question I think we've heard from basically all regulators, right? Because, and again, especially when we are talking about open and decentralized blockchains, that's the question that comes up, right? And say, okay, but if anyone can join and participate, what are the risks that, I don't know, anonymous validators from North Korea will be validating transactions, or transaction fees will end up being paid to entities in sanctioned jurisdictions, right? And then again, it depends a bit on the blockchain and the space of public blockchains. You will see some different options out there that avoid these very tough issues, and regulators are completely right in asking that question. And just a kind of a self-criticism, it's not that we are trying or we are asking regulators to understand the details of every chain that is available out there, but more that they think about features and approach those features from a risk management perspective instead of just using the two basic categories. So in terms of governance, and you mentioned, Luis, at the beginning, that's one of the features that regulators could take a look and say, okay, how do you manage operational risks and reputational risks there? And then for the Stellar blockchain, for example, it's not based on proof of work, it's not based on proof of staking, it's based on proof of agreement. And that means that all validators in the network continues to be open and decentralized, but all validators are known entities, because for a new validator to join the validator set, this new entity has to be trusted by the existing validators on the network. So only trusted new validators can be brought in to the validator set. So that avoids any validators, anonymous validators in sanctioned jurisdictions. And since the Stellar blockchain, transaction fees are used to make sure that the network works securely and they are burnt in the end. So no validator will receive financial incentives or rewards or new tokens by validating transactions. So that brings neutrality to the network and also avoids that some transaction fees end up paid to validators in sanctioned jurisdictions. So the idea is that we have options out there, but that is definitely an issue that we have to face and explain the best we can, so that not only regulators, but as you said, Luis, everyone out there, even us, can better understand how public blockchains really work.
Yeah, I think it's a really good point that it's you don't necessarily need to know exactly how it's done, but you, as a regulator, you should decide exactly what the features look like. Anyone want to add anything on the validator community's point, or shall I go to the next? Yeah, Isadora, please.
I mean, just to build on what Marcelo said, obviously for Hedera, it's a very different kind of setting because we are permissioned. So in that respect, we have selected our nodes on the basis of kind of their trustworthiness and their location being kind of helping regulated third parties being OFAC compliant in the case of kind of US banks. But I think fundamentally, what was really interesting to discover throughout these sessions in the summer is that there are kind of terms and conditions that issuers can actually kind of apply to kind of like the environment within which kind of they transact with each other as another market ecosystem participants. And, you know, if you think about the question, for instance, of cross-border kind of distributed market infrastructure, how do you think where kind of like the transaction has taken place and kind of like what laws apply to that, and kind of like the conditions within which like the transfer would be deemed kind of final. All of these things are actually kind of like obviously kind of an interplay between the legal frameworks of each jurisdiction, but also a design that can be made at a kind of smart contract and asset level that doesn't necessarily preclude kind of like, you know, you don't necessarily have to make that architectural choice at the settlement layer.
Thanks very much, Isadora. Yeah, and I think that was something that was a big learning process for me throughout this, was just how much can be done other layers other than the settlement layer, you know, asset, token level permissioning, etc., and also at the sort of platform operator level. And I think that was something that regulators also were not aware of as well. I think there's this idea that public permissionless blockchains don't exhibit, you know, this level of controllability that you can have with permission token standards. We have a sort of broader, more, I guess, thematic question here, which I think is quite interesting, and maybe a couple of you might want to speak to this. Why are Stripe, Google, PayPal, etc., spending so much money building their own blockchains? Why not a single shared blockchain for financial services? Yeah, indeed. I think we've not touched on this that much in the report, so yeah, might be worth discussing now. Matt, if I can pick on you, why are they not using Ripple, say XRP? XRPL.
Well, I don't know about that specific. I mean, it's probably better not to get into the specifics of what individual companies are doing, but I'll make a more general point, which is that, you know, the reason there are so many different sort of blockchain solutions out there is because different blockchains are designed for different purposes. They have different strengths, weaknesses, and there are trade-offs involved. So, you know, it's very unlikely that you could design a single blockchain that did it all. You know, there's a good reason why there's quite a diverse, varied universe out there. I think there's also there's also a reason why some companies want to offer their own blockchain, which is because today there is although this is something we'd like to change, there is still quite a lot of friction that makes it difficult to operate across blockchains. Although this is something, you know, interoperability is something that the industry is working very hard on, and there are some great solutions that are being developed. The reality is there are some frictions which mean that it may be more efficient to have operations on a particular blockchain. So, you know, a private company might want their own blockchain because they hope it's going to function a bit like a walled garden, and they're going to be able to sort of hold business within that blockchain. You know, in reality, I personally doubt that's the future. I think the future will probably be quite a vibrant and varied ecosystem with interoperability protocols.
Thanks very much, Matt. Yeah, I think it is an interesting one because I think in some ways we can all imagine this idea of one shared blockchain to rule them all, as people are fond of saying, and from, you know, we have the BIS Finternet project. There is something appealing about that idea, but as you say, the reality is it's not really the trajectory we're going to. But interoperability is between different blockchains with different qualities is kind of a much more reasonable goal. Just picking up on one of the themes that it was a big part of the report that I want to get to. We'll come back to the audience questions in a moment. John, I wonder if I can come to you on this and ask a little bit about the decentralized nature of blockchain. I think this is something that came up a lot with the regulators we spoke to, right? As a concern for them. How do they supervise something decentralized? Can you talk a little bit about, you know, what we've discussed in the report in terms of the attitude that regulators should take to that? You know, what level regulation should occur at?
Yeah, and I think I'd like to kind of reframe it as instead of a problem or a concern. I think it's certainly something that regulators are trying to wrap their heads around. It's a completely different model for financial or tech infrastructure than kind of currently exists today. And so I think coming to a nuanced understanding of both the advantages and potentially the disadvantages of decentralization is something that is required a lot of education and I think a lot of future education. But I think also I just want to point out that there are a growing number of regulated use cases existing today and in development today that regulators have gotten very comfortable with that exist on public chains, including Aptos and Ripple, Hedera, Stellar, and many others. As an example, stable coins, obviously Circle is a regulated entity in the US and I think Europe at this point and probably other jurisdictions. They've launched USDC on, probably a dozen chains and growing. And I think we'll see banks really growing those kind of regulated stablecoin offerings, especially with the passage of Genius in the US and obviously the MiCA framework in Europe. And then additionally, there's institutions like BlackRock, Apollo, and Franklin Templeton that have offered regulated money market and other types of funds on Aptos and other chains that are here today without any sort of issue. They've worked through their kind of normal standard issues with regulators, but like the fact that they're launching on public chains has not been controversial, and these have been, existing without major issues for probably several years at this point. And then there's other kind of contemplated, I know HKMA, the Hong Kong Monetary Authority is doing a pilot on the Hong Kong dollar that we're participating in, and a number of other regulators are kind of engaging in this space. So I think while it's a different framework, it's not something that regulators haven't been able to sort out and institutions haven't been able to launch on. That being said, I think, what's crucial is really a firm framework, a delineation on the roles and of regulation and accountability. And I think, like, as you referenced, we see it as really, can institutions meet their regulatory obligations by using any sort of technology, including public chains? And so as long as they can demonstrate that, a tech neutral approach, we think makes sense with the onus on the issuer of a money market or a stablecoin to say, hey, these tools exist on this chain and this chain. If we have concerns about X, Y, and Z, these are solutions. And then they can go from there. But I think that's like kind of the crux of it. Although obviously there's plenty of other issues as well.
Yeah, absolutely. But I think, it's a really good point to highlight that it's not like we're talking about problems for the whole of regulated finance. There are plenty of regulated financial instruments already on public blockchains that are in operation. It's specifically banks that have some unique challenges, and I think regulators are kind of coming to realize that it's a slightly artificial distinction to make it especially hard for banks. We've got an interesting question here that I think is worth elaborating on, and that's elaborating on public DLTs as open versus privately owned, public owned. Should DLTs be considered public services or public infrastructure? There's a few different ways to approach this question. Isadora, I wonder if I can pick on you for a moment, just because we were talking earlier about the slightly excessively broad brush that some regulators are painting with, and I think there's a few different elements to discuss in this question. But interested in your thoughts.
Yes, I mean, I think the point that Matt from Ripple made at the beginning is really, really important, because I don't think that all blockchains were designed for banking kind of purposes. We are kind of like approaching this discussion through that narrow lens. And we're talking kind of like in the hierarchy of like thresholds and appetite for risk. That is probably like the highest, in terms of what regulated institutions need to meet. And the reason I say this is because if you look at the landscape of money and payments instruments overall, there are different kind of like, digital currencies are kind of subject to different kind of contractual obligations and legal kind of and private ownership. Assignation as well as central bank money needs to meet some very kind of like stringent requirements. So I think the reason why I'm saying this is that we're seeing like that we have this mosaic of architectures is because fundamentally, if we're talking about the kind of like the infrastructure of the future that will underpin banking, then we can look at certain jurisdictions that have taken the approach of actually building this as a public utility, right? Like if you look at Brazil and you have RTGSs that are considered kind of like public infrastructure. But I think historically, we've always seen the development of private-led solutions, and then kind of like as regulators develop their understanding and their comfort with these technologies, they come to a sense of like whether they need to build their own infrastructure. And I think most central banks around the world are posing themselves whether kind of they are kind of centralizing dependencies if they do that in this kind of constantly changing ecosystem, or if that's kind of like the choice they need to take. I think fundamentally, kind of like to protect their remit and to protect kind of like the, you know, their powers basically. But I think fundamentally on the decentralization question, it's just that, and going back to the point that Matt made, because we even make the mistake of always saying that blockchain is financial market infrastructure, we are having a discussion about how does financial market infrastructure need to operate and how is it regulated, right? So, but blockchain, if they have kind of like a plethora of use cases, then we need to think kind of like outside the box in terms of how do we build centralized infrastructures atop these decentralized environments so that we can have kind of like the trust and contractual liabilities that help kind of regulated institutions meet their obligations. And just an associated point to that, and I know Marcelo will chime in as well, is that, you know, questions of kind of like legal finality, et cetera, are outside L1s, but obviously within kind of like the protocol level, operational resilience questions and tech specific concerns is something that we're seeing kind of like the layer one community be more proactive about explaining how they, because these are kind of technology risks, not financial risks. And as a result of that, there needs to be greater cooperation and dialogue.
Yeah, absolutely. Yeah, Marcelo, straight on to you, please.
Thanks, Luis. No, exactly as Isadora was saying, when we think about public blockchains used for financial services, I think they are really similar to a public infrastructure, but not exactly to the traditional financial market infrastructures that exist today. Because if you, and this is an example, if you think about a payment system in any country or jurisdiction, you have all assets running on the same public system, on the same financial market infrastructure. So if a financial market infrastructure like payment system goes down, you cannot move money anymore. Bank deposits are not available to be transacted. You cannot make transfer. You cannot make payments until that infrastructure is brought back to operational level, right? For blockchain infrastructure, it's a bit different because we usually have the same asset deployed in multiple blockchains. So even if one of the blockchains goes down, the asset can exist and continue to circulate in different, in the other blockchains where this asset was issued. So in this sense, it's a bit different because here you can have a kind of a multi-chain redundancy. And that leads, as the issuer of each asset has control or can have control over the asset, that leads to a kind of a portability of digital assets. It's not because one of the blockchains went down that the issuer cannot solve the problem. If it's a persistent problem, the issuer could always burn the token on that chain and mint the same token, issue the same token on another chain to the same public address held by any user, wherever or this user is. So that's kind of an important difference to take into account, because it gets to the question of operational resilience, right? And how public infrastructure like blockchain would function and would be different from the traditional financial market infrastructures that we have today.
Yeah, absolutely. That has partly answered the next question from the audience that I was going to ask. Vivian, I wonder if I can come to you for this. the question is, what are the strongest use cases for public blockchain, and why are existing financial services architectures not sufficient? I mean, I don't know that we'd say not sufficient. Obviously, they are working at the moment, but capable of being improved upon. Marcelo's just given an example with this operational resilience feature. Vivian, I wonder if you'd like to say a little bit more on that topic.
No, well, I mean, it's having the most, and I agree with my colleagues. This is very ambitious and ample, because I mean we had to deal context by context. I mean, when we deal with public infrastructures, we have not only just and blockchain. I mean, in this report and in this context, we are thinking about financial services, but there's other very important topic about blockchains and supply chains, and at the end, supply chains join the digital currencies and the digital world, and everything will move together. So there are very different use cases and very pertinent use cases. But what I've seen and what I would like to address right now, because it has been a shift, and I think at least in Europe it's a major change, is the step that the Central Bank of Europe has taken in make the DLT interoperable with the current RTGS, with the current infrastructures that we already have in Europe. So this will move the innovation in financial services to the right point, to the asset point. So at least for in a short term, we can deal with a part of the problem. We can deal with something more specific, and blockchains like Ethereum, Aptos can focus on their functionalities instead of thinking of being interoperable with the money, and leave the money kind of as a leg between in the financial market. So I think this is a major shift and a major introduction in Europe, the Pontes project from the ECB. Yep. So the DLTs, and we have the pilot regime, and then we talk about public or permissioned or permissionless, public or private. But now the fact that they can interoperate with the rail, the actual rails, is a major shift. And Brazil is also moving toward that. Yeah. And that is very, very relevant right now.
Yeah, absolutely. For anyone interested in Project Pontes, learning more about that, we are running a roundtable with the Banque de France in a couple of weeks, I think. Yeah, later, I think towards the end of November. Very, very exciting project. And yeah, we'll be really, as you say, it means it puts the sort of foundation for development of tokenized assets in Europe on a different footing when the cash leg is taken care of. I'll throw it open to the panel if there's anyone else who wants to highlight ways in which public blockchain-based infrastructure can improve on traditional infrastructure. Yeah, feel free to jump in.
I might jump in, Lewis.
Yeah, go ahead, Matt.
You go, Matt. Yep, we'll come back.
Go on. I'll be quick, Marcello. You can go after me. So you know, the operational resilience, I think, is one of the key features that we often hear central banks and regulators require from financial market infrastructure, and I sometimes do encounter this view that a decentralized ledger is somehow less resilient, you know, because it's maybe fragile, you know, because all of these different validators around the world all need to agree on the ledger. And I actually think this is quite misleading and wrong. You know, if you look back at the history of this infrastructure, the reason that was the decentralization was introduced was actually to increase resilience. You know, distributed computing is a field that was developed to try to increase the resilience of systems, because it reduces the vulnerability to one particular node going wrong. So, you know, I do often make the argument to central banks that a well-designed decentralized ledger can actually be more operationally resilient than a traditional one. So, you know, they I think should be coming at it from that starting point, that actually this could result in a better outcome.
Yeah, absolutely. And I think we often forget that often doesn't really make the news when the traditional systems do go down, but they do. And regulators, it's funny because, you know, people will talk about operational resilience in blockchain context as if they were comparing to a perfect system that doesn't go down at all. But actually, what we're comparing to is a system that does go down, but with a frequency that people understand and prepare for. But yeah, totally possible to improve on that. Marcelo, anything else you wanted to highlight other than the operational
Sure.
resilience?
Yeah, no, just to come back to one example, and John mentioned that as well. When you think about, okay, but why should regulated entities use public blockchains, right? So the example here is Franklin Templeton. They are a global investment company, and they started to issue their money market fund shares on Stellar back in 2021. Mind you, they are regulated by the securities regulator in the US, the SEC, which for a long time was the most, we can say, the most skeptical regulator out there regarding the use of blockchain and digital assets. And they received since 2021, they received the green light from the SEC. They've been issuing these money market fund share on chain, now not only on Stellar, on multiple blockchains. And it's interesting, as they mentioned in some of their executives, they said they were able to reduce, at least on Stellar, the record keeping and reconciliation costs from $1 per transaction to a cent per transaction. So if you think about, Franklin Templeton manages like $1.7 trillion in assets under management. And as they said, for the past 10 years, costs went up 80% in this sector and revenues went down 15%. So it's meaningful, the reduction in the significant reduction in record keeping and reconciliation costs. That means a lot for an issuer like Franklin Templeton. And the other side of that, because of that reduction in cost, they were also able to promote these money market fund shares. The initial investment on Stellar is only $20. So for a traditional money market fund in the United States, maybe someone would have to make an initial investment of at least $5,000. For Franklin Templeton on this on-chain money market fund share, any person in the US can make the initial investment of only $20. So this also means it's good for the issuer, it's good for financial consumers as well, and it's a matter in this case of increasing financial access in the end.
Yeah, it's a really important point to highlight that, you know, for many years we talked about these ideas as sort of distant things that would improve efficiency in the future. And when you look at things like the blockchain bond market, when, you know, KfW and EIB try issuing a blockchain bond, we're still kind of at that stage. It can be a real bond, but it takes a lot of effort to issue, and maybe it'll be an improvement in the future. But we are already in other cases at places where this is already, you know, driving new business and saving material costs in production. I think that's worth highlighting because it actually happened quite quietly, unlike almost anything else in blockchain somehow. So we are coming close to winding up. John, I wonder, well, yeah, I'll give you all a chance for some final thoughts. One of the things that we should probably highlight is what regulators can do to make adoption easier among banks. Also, you know, returning to the focus on functionality of the technology. You know, if anyone would like to highlight a key functionality, these are a couple of areas that I'd like to touch on before we finish. John, I wonder if I can come to you for a first final thought, if there is such a thing.
Yeah, I mean, I think we talked a lot about operational resiliency, which I think is just a core feature of kind of distributed systems. But I think one that we haven't, as you kind of alluded to, is kind of the flexibility and the potential controls that the technology has. And I think it's evolving day by day, both on a kind of a compliance front and a confidentiality front and others. But, you know, on Aptos, for example, and I think this is certainly not unique, and I think many of the others that are here today can speak to similar types of controls, but regulated institutions can meet their obligations with a kind of a menu of token controls. So if you want to be able to have the ability to claw back tokens or freeze tokens or implement KYC kind of flags into the assets of the wallets, there's lots of capacity to do that. And so, you know, kind of building out the broadest set of options that regulated issuers can choose from to meet their obligations, I think is a great way a neutral way for this technology to kind of be adopted and regulators to be comfortable with it being adopted by banks and other regulated institutions.
Yeah, absolutely. A very important message, and one that I think in the discussion with regulators, they were kind of surprised by some of that flexibility. Vivian, can I come to you next, and perhaps on the topic of what we'd like to see regulators doing going forward to improve the market?
Yes, Luis. Well, I think for banks to make it easier, the adoption easier, I will say two things, like improving certainty and reducing fragmentation. I think we have talked a lot about improving certainty and the operational resilience. So I would like to add something else about fragmentation, which is something that it makes a little bit uncomfortable the regulators, because they don't feel comfortable addressing that themselves. So here again, the collaboration of the industry is key, and with the technology providers, and I will include also the standard bodies as well, so we can have a financial system with the different blockchains, but common standards. Because when we move right now, we are in the e-money tokens, stable coins, but securities. But when we move to real world assets and its tokenizations, to be certain that a token in one chain is the same when it moves to another chain, it will bring comfort to the system as a whole. So I strongly advocate for machine readable schemas. So compliance can be embedded in a code and checked automatically. No, this is a lot of work and it's not really simple. But with this and over time, and with this in my view, with this, all the standards will help technical settlement finality come closer to legal settlement finality, and maybe we can get the blockchain to have a full legal weight. Yeah. So the main point is collaboration and between the participants.
Yeah, it's been impressive to see the way in which, with using open source protocols, the industry has kind of evolved some of these standards themselves, but as regulators get more and more involved, they actually have a lot of capacity to shape direction there, and it could save a lot of wasted effort. Matt, working around my screen, if I can come to you for some final thoughts.
Yeah, I mean, just very quickly, I'd like to end on one thing, which is that what central banks and regulators really should be looking to do is to produce some very clear principles-based standards that public ledgers would need to meet in order to be used for institutional finance. And I think particularly because if you look around this group of people, none of the representatives on this call have got the ability to unilaterally change their ledgers, even if a regulator tells us to. But if there is a clear set of global standards, sort of principles based, not prescriptive, we can then make the case to the ecosystem, to the communities that underpin the ledgers that we work on, to make any changes that might be needed to meet those standards. But that does need to be globally coordinated.
Yeah, a really interesting process. Isadora, can I come to you, please?
I mean, I would definitely concur with both Matt and Vivian. I guess to not be repetitive, one question, well, actually, like, it is repetitive because Vivian mentioned it, but the question of legal finality will be a really, really important kind of like piece of the puzzle, and kind of like the appetite for deterministic versus probabilistic finality. I think one of the really nice features that Hedera, for instance, has is that of having predictable fees. And it's not one which we see across kind of all chains, and one that will need to be factored in as kind of like, institutions start building kind of like fully on-chain. Cost predictability will be a really important factor, which is not necessarily a regulatory consideration, but probably more a financial consideration.
And it's these financial considerations that market participants should be basing their choices on, right? But at the moment, that can be difficult because of the regulatory hurdles. Marcelo, for a final thought to you, please.
Yeah, thanks, Luis. No, just, two quick takeaways. I think the first one is not all blockchains are created equal. And the second one would be for all regulated entities, banks, regulated financial institutions, and regulators out there thinking about blockchain. Let's try to build a better analytical framework, moving beyond the public permissionless, private permission distinctions that are not useful anymore.
Yeah, absolutely. And a final takeaway from me, download the report. We have put a lot of work into not prescribing exactly what policies should be. Obviously, individual regulators will take their own views on their priorities and how they want to see things done, but on the areas in which those standards should be set, and it'll be up to the regulators to decide what those standards are. But the industry, both the financial and the blockchain industry, are kind of crying out for this. So it's going to be, yeah, it'll be very valuable to see that development from regulators going forward. Thank you to the audience for tuning in today. Thanks so much to my working group participants. It's been an absolute pleasure working with you all. Learned so much from the process, and you've all been very, very helpful. Yes, to the audience, thanks again for tuning in. Make sure you check out our website, omfif.org. You can get the report. I think that's in the description for you, but on the website you can get a lot more information about the events we have coming up, podcasts, other reports, commentaries on this topic, and many more. So yeah, please keep in touch. We'll be doing something similar to this next year, similar topics, but refreshing for the evolving policy and technical environment. So keep your eyes peeled for details of that. Thanks again for tuning in today. Thank you to all my panelists. Goodbye.
Thank you.
Thank you. Goodbye.